Welcome Dr. Shaima and the group. We'll do a quick recap of managerial decision-making under uncertainty, inspired by Managerial Economics and Strategy. Over the next 4 minutes, we'll revisit the key points we explored about making better decisions when faced with uncertainty. Let's get started. On April 20th, 2010, the Gulf of Mexico witnessed a catastrophic event, the Deepwater Horizon oil rig explosion, leased by BP. This incident highlighted the immense risks companies face and the importance of understanding and managing uncertainty. Uncertainty is a part of life and business. From market fluctuations to natural disasters, managers must navigate a wide variety of risks. So, how can they make informed decisions in the face of uncertainty? In this chapter, we covered 5 key areas: assessing risk, attitudes toward risk, reducing risk, investing under uncertainty, and behavioral economics and uncertainty. First, we discussed assessing risk. Managers use probability, expected value, and variance to measure and understand risk. For example, if a promoter is considering an outdoor concert, they need to weigh the likelihood of rain and its impact on profits. Expected value helps managers summarize potential outcomes. It's the average of all possible values, weighted by their probabilities. For instance, if there's a 50% chance of rain affecting a concert, the expected profit is calculated by averaging the profits from all scenarios. Next, we explored attitudes toward risk. People are generally risk-averse, meaning they prefer to avoid uncertainty. This is shown by a concave utility function, where the utility gained from each additional dollar decreases as wealth increases. We also looked at how managers can reduce risk through diversification and insurance. By spreading investments across various assets, they lower the overall risk. Insurance provides a safety net, compensating for losses from unforeseen events. When it comes to investing under uncertainty, we examined how managers evaluate the riskiness of payoffs and the expected return. Decision trees help visualize possible outcomes and make informed choices based on potential risks and rewards. Finally, we touched on behavioral economics, which reminds us that managers are human. Psychological factors, such as overconfidence or fear, can influence decisions. Understanding these biases helps managers make better, more rational choices. To summarize, effective decision-making under uncertainty involves assessing risks, understanding risk preferences, employing strategies to reduce risk, making informed investment decisions, and accounting for psychological factors. By mastering these concepts, managers can better navigate the unpredictable world of business. Finally, we've prepared some recommendations for you to follow, as well as common pitfalls to avoid in your practical career as a manager. Recommendations: quantify uncertainty. Use probabilities, expected values, and variances to assess the risk and potential outcomes. Quantifying uncertainty provides a clearer picture of the potential risks and rewards. Diversify investments. Spread investments across various assets to reduce overall risk. Diversification helps to mitigate the impact of any single adverse event. Use decision trees. Visualize possible outcomes and decisions using decision trees. This tool helps in understanding the sequence of events and the associated risks. Understand risk preferences. Assess the risk tolerance of decision makers. Knowing whether managers or stakeholders are risk-averse or not can guide appropriate decision strategies. Obtain relevant information. Gather as much relevant data as possible before making decisions. Accurate information can significantly reduce uncertainty and lead to better decision-making. Consider behavioral factors. Be aware of psychological biases that can affect decision-making. Understanding common biases such as overconfidence or aversion to loss can help mitigate their impact. Purchase insurance. Use insurance to transfer risk. It is a useful tool for managing potential losses from unforeseen events. Plan for worst-case scenarios. Always have a contingency plan for worst-case scenarios. This preparedness can save resources and time if things go wrong. Common pitfalls: ignoring uncertainty. Pretending uncertainty doesn't exist or failing to properly account for it in decision-making can lead to significant losses. Always acknowledge and quantify the risks involved. Overconfidence. Managers often overestimate their ability to predict outcomes. This can lead to taking on more risk than is prudent. Lack of diversification. Investing heavily in a single asset or project can be disastrous if it fails. Diversification is key to managing risk. Failure to update information. Not updating decisions based on new information can lead to outdated strategies that don't account for current realities. Underestimating the importance of behavioral factors. Ignoring psychological factors and biases can skew decision-making. Being aware of these factors is crucial for objective decision-making. Inadequate risk assessment. Poor assessment of probabilities and potential impacts can lead to bad decisions. Use statistical tools and historical data to better understand risks. Ignoring smaller risks. Focusing only on large risks and ignoring smaller ones can accumulate significant losses over time. It's important to consider all potential risks, big and small. Over-reliance on past data. Relying solely on historical data without considering current and future changes can lead to inaccurate risk assessments. Always contextualize past data within the present and future landscapes. By following these recommendations and avoiding these common pitfalls, managers can make more informed and balanced decisions under uncertainty. Thanks for watching. See you next time.